If you follow this channel, then you're well aware that real estate is one of the greatest vehicles for economic prosperity in America. We're going to cover in this video how residential real estate is about to be one of the hottest asset classes yet again in the next 3 to 7 years or so. We're going to cover the factors influencing it, and we're going to talk a little bit about how you can get in or get in further on this opportunity. Residential real estate in the Gulf South in particular is going to be as hot as it gets in the next couple to few years because of so much downward pressure from so many different angles at a time when inventory is at its absolute shortest has been in a very long time, if not ever. So we already know that we're 4 to 6 million homes short in the United States when it comes to inventory. That in itself is putting massive pressure on the residential real estate market. If you fast back to COVID times when interest rates dropped down, the Federal Reserve, out of insecurity of the economy shutting down, pulled interest rates all the way down near zero and then pumped money into the system. We had an absolute frenzy in the residential real estate market, amongst other asset classes. That having been said, interest rates have gone up quadruple since this point in time in 2020, 2021, and 2022. We sit here in the summer of 2023 with the Fed's funds rate at 5.5 and hiking, the highest it's been in over 15 years. The pressure this is putting on real estate basically took it from 30-40% gains the last 2 years down to single-digit gains, and in some markets even negative. But for the most part, real estate has hit a new ground floor. We're still at the highest median home prices we've seen in the United States. This in itself is a major sign that residential real estate is only being blunt temporarily by those rate hikes. So let's talk about a couple other factors. Again, expounding on the Federal Reserve's effect on this. The Federal Reserve is going to end up getting to the same point through two different pathways. The Federal Reserve projects by 2025 that they're going to be able to get the inflation rate, core inflation rate, down to 2% by 2025. Many economic analysts believe that they may not make it to 2025. But even if they do, let's just say that they're successful. If they can get core inflation down to 2% by 2025, this will almost automatically pull mortgage rates down with it, because mortgage rates tend to rise and fall in reasonable correlation with inflation. So let's just say the Federal Reserve is not successful and other analysts are correct that the Federal Reserve is going to experience serious cracks in the economy before they can get to that 2% core inflation target rate. If that's the case, the Federal Reserve will likely be forced to pivot, in which case they'll pull the Fed's funds rate down. The 10-year Treasury will respond in correlation, thus pulling mortgage rates down. In either occasion, they're going to pull mortgage rates down. This in itself happening in the next 1 to 2 years alone will happen before the inventory crisis can be resolved through building or through foreclosures. With that being the case, you have a natural spike in the available residential real estate because there's going to be so many different borrowers out there on the sidelines who are going to be able to afford property again for the first time in 2 to 3 years. Let's go with the next major factor that's going on again, which is the inventory crisis. Foreclosures are not showing any strong signs of hitting the market in any mass numbers, in many markets at least. And building is not going to move fast enough that we can see to make up for this massive shortage either. We have a large demand in the United States for home ownership, as well as rentals. So with that having been the case, why is the Gulf South a particularly hot spot for real estate coming up soon? The Gulf South is going through its own unique real estate crisis with insurance. Homeowners, flood insurance is absolutely insane in the Gulf South. I'm talking about $8, $10, $12, $15,000 a year in annual costs for homeowners insurance alone. Those of you who own homes already may already know this is absolutely exorbitant on, $150,000, $250,000, $300,000 homes. This is a massive spike in insurance. You're talking about normal insurance rates being somewhere around $2,000, $3,000, or $4,000 a year, and even in some markets that's still high. We're up over $10,000 from Louisiana to Florida when it comes to homeowners and flood insurance, because insurance companies had to pay out so much from consecutive natural disaster events over and over the last 3 to 5 years or so. With that having been said, you have a unique situation where one of the most affordable markets left in the United States that's not, You think about the Northeast, you talk about the West Coast, you talk about pockets of the Midwest. And you have to combine desirable places that are still affordable. Okay, I'm sure there's probably some unknown place in North Dakota that's really cheap, but we're talking about places where people actually want to live. When you look at that component, we're talking about the Gulf South being one of the most attractive, business-friendly places to buy a home, affordable places to buy a home. The weather is the nicest. And with that having been said, we have insurance making it completely unaffordable to buy a home. If you think about $12,000 in homeowners insurance and an annual premium, that means that's $1,000 a month alone in your escrow. You know how that affects your affordability when you go to buy a home? It's insane. We're talking about tens and tens of thousands of dollars a home you can no longer afford because of insurance alone. Taxes they're doing the same thing as well. So with this being the case, this is an outstanding time to swim upstream. Why? Because all of those factors are going to be temporary. The Federal Reserve is going to either win this battle against inflation or it's going to lose. In either case, mortgage rates are highly likely to come down 1.5%, 2% from where they are now, even going back into the 5s range, somewhere in the 5 to 6 range. Below 6, above 5 is going to unlock the door for hundreds of thousands of buyers that are sitting on the sideline right now. The insurance situation is also temporary. It's a monster. But if you have a few consecutive years without any massive natural disasters to be paid out on, or right now, let's say in Louisiana, for instance, the government has stepped in and started to give grants. They've started to basically subsidize this market to keep this going because they know this is unsustainable. You're talking about pushing tons of existing homeowners out of their homes if you're not careful, and even more of them out of the buyer's market with just insurance and taxes. It's completely unsustainable, and it'll backfire on those local counties and municipalities and states because that's revenue they're not going to be collecting. The insurance companies are going to be getting it. So they can't let that happen. They're broadening competition in the insurance market by subsidizing it, and this is intended to bring down prices. So this is another temporary problem that's giving downward pressure on real estate, especially in the Gulf South, from Texas to Florida. You need to get yourself in position. If you're not already in position, you need to get your dry powder ready, as my friends at One Rental at a Time like to say. This is going to be one of the golden opportunities when inventory will be the last thing to correct itself. This insurance crisis is going to fix itself. This Federal Reserve interest rate crisis, mortgage rate crisis is going to fix itself within the next 12 to 30 months or so, year to 2.5 years or so. This is largely going to be corrected. Hundreds of thousands of buyers are going to be available in the residential real estate market with a fraction of the inventory to go after. And this being the case, you need to get yourself situated. What does that look like? Establishing a massively strong relationship with a great financial institution that you're going to want to borrow from. Many of you are huge fans of Navy Federal. Some of you Chase Bank. Others of you local and regional banks in your given market. This is going to be the time to pad that relationship and swim upstream and get in the next year, year and a half, maybe 2 years. But I really think in the next year, year and a half, this is where the best opportunity is going to be to get into real estate. This is even if you're just going to be a homeowner. You don't have to own 15, 20, 25, 30 properties to take advantage of the economic circumstances in the real estate market we're about to experience. The housing market can pay off big for the right homeowners who buy now and have enough time to pay that house down, to add value to it, buy in the right neighborhoods that'll continue to have value and see massive upper single digits to double digits returns in these various markets. I'm telling you right now, this is going to be a golden opportunity. Get your banking relationships together. Get your credit together. Get access to these high-limit credit cards. Exercise personal loans to develop your installment history, which is needed when you're trying to qualify for a mortgage. Get these things together. If you want to use Navy Federal's pledge loan hack, which you can use at almost any credit union or small institution that offers secured loans against savings and CDs, you can get any relationship you think that's going to give you the best lending terms on a mortgage. You need to get in with that institution right now. The financials you need to get qualified for a mortgage is 2 years worth, whether it be tax returns, industry you're working in, income, all of that stuff, credit history. You need 2 years or more of each in each one of those categories to qualify. Pay down your debt, get your DTI, debt to income ratio, in position to afford a mortgage. They're not going to want to see any more than about 30 some odd or 40 some odd percent tops on that mortgage cost against your monthly gross income. That's going to be your DTI. It's called the housing ratio, front end housing ratio. Your front and back end DTI needs to be pristine. You need to leave room for it. I'm telling you right now, if you can afford to buy a home, if you can afford it as a primary residence, a secondary home, or an investment property, I'm telling you right now, if you can get yourself in position in most of the United States, but especially in the Gulf South, you're going to be grateful 5, 10, and 15 years from now that you did. Even 1 or 2 properties can change an entire retirement portfolio if you're looking to retire early, or at least just retire on time. Because I'm telling you right now, it's not a guarantee many of you will. This is your opportunity to get in. I want you guys to comment down below and let me know what you think about this theory, this breakdown I gave. Do you see the opportunity that I see? Do you believe that it's not going to be there? I want you to comment down below. If so, let me know what markets you're interested in getting involved in as a homeowner or as an investor, real estate investor. Get down in the comment section and let me know. Other than that, to all my pioneers, welcome back. To my new viewers, welcome in. You want to learn more about me and the channel? I want you to start in the description, work your way to the about section, subscribe, of course, and share this with anybody you believe that can give value if you want to expand this conversation. Other than that, I want y'all to stay focused, stay in motion. I'll see y'all soon.
This is JP from Blueprint for Prosperity Network, a channel dedicated to helping you increase your net worth through relationship banking, maximizing your borrowing capacity, the proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity.